Welcome back. You're watching The Money Show with me, Kavita Thapliyal, and let's move on and let's talk about identifying the right kind of companies for maybe a longer term duration or time horizon or investment horizon. And even if you want to make a quick buck considering the festive season, we have you covered because today I have with me Vivek Karwa from VRIDHI Investment, who's going to help you out in identifying the right kind of companies and also will be recommending few. So Vivek, good evening and welcome to the show. Very important discussion because either it is a short-term investment horizon or a longer-term, maybe a goal-specific investment that you want to do. It's very crucial, very important to understand the kind of investment instrument that you're investing into, and also within that, if you're talking about equity market and you're talking about picking up a company and picking up a stock of that company, you need to know a lot of things, a lot of homework, a lot of research needs to be done. I mean, on ET Now, throughout the day with experts like you, we keep discussing about these factors, but then today on the Money Show, Vivek is going to dissect this further. And for a layman, Vivek, what would be the right way to approach the investment horizon if at all you want to pick up any company and the stock of that company?
Okay, good evening and to all the viewers and to you too. See, when ET Now asked me that they need some pointers for this show, I thought, okay, instead of giving a lot of jargons, EBITDA, P ratio, that there's all numbers, what could be the easiest way for a layman actually to pick up a company and still not go wrong? So today's it's in the age of internet, most of the data is available online. And the first thing I would always look into the company is how long the company is in business. In fact, whenever last 22 years I'm in this markets, and I've seen that many companies keep changing their names, keep changing their business profile with the cyclicality of the businesses. So, in fact, if there is IT boom today, they might become an IT company. If there is infra boom, they might again become an infra company. So there are many instances wherein people have got caught in this mess. So look at how long the company is in business. That would really help you out. And then the basic number. See, finally keep in mind market rewards EPS, market rewards profits if the company is earning. Okay, and nothing else. So even in a bad market, if the company is going to make good profits, the market would finally, at the end of the day, would reward the company. And that's the reason even during bad phases, we see some companies doing very well. So there are data available. In fact, on BSE side and on NSE side, you can always download that and look at companies' performance over last 3 to 5 years. As I said, you need not go into other numbers in balance sheet and profit and loss statements because that would be confusing for laymen. But you can just look at the net profit, what the company is making. So if there is increase of at least 12 to 15%, which means company grows at least at 7-8%, and another 6-7% of inflation. So if the company is growing net profit at rate of 15%, that would be ideal company to invest in. Now, there have been instances in the past where the company makes money but does not pay taxes. So there could be reasons. The books might be decorated, I can say, or even inflated. So if a company is making money, they got to pay taxes. Look into the data if the company actually has paid taxes. So if one side the company is making profits, other side the company is paying taxes, which means the profits are genuine. So these are first three things. And then lastly, look at the shareholding pattern of the company. Now, if a company is well researched, well tracked, you will find that a lot of FIIs are invested in that company. A lot of mutual funds have been investing. A lot of other DIs also are investing in that company. And there might be big names. For example, of course, he is now no more. Say, for example, Rakesh Jhunjhunwala. There might be big names also which have who have invested in this companies. And hence, indirectly, as a layman, as a small investor, I might not be able to ask questions to the company or really question them if there is something wrong. But if FIIs, DIIs, and big names are invested, these companies also are double cautious. So always look at the shareholding pattern. And sometimes you'll find that some promoters are either increasing the shareholding, their own shareholding, buying from the markets, or at times decreasing. Last 1 month, in fact, 1 to 3 months, if you look, you will find that in small cap companies, many of the promoters have actually reduced their shareholding, which means promoters themselves are feeling that the valuation of the company is too high and hence they should cash out a bit. So you should look at that trend also. So these are 4 or 5 things. If you have eye on this alone, I can say at least 90% of your problems can be sorted out and you would not make losses.
All right, so Vivek, quickly, let's talk about your recommendations and the reason why you're making these recommendations.
Okay, I would, this would be again for medium to little longer term. The
Okay.
first bet would be Indigo. Now, Interglobe Aviation, we are seeing what is happening in aviation space. SpiceJet is almost out of business. Go Air is already stalled. And Indigo is one company and other companies are not listed. In fact, you don't have many options if you really want to participate in the aviation sector. So Indigo, in fact, today they have announced that they are going to charge fuel surcharge of rupees 300 to 1,000 rupees per seat, per ticket, which is going to increase the yield of the earnings overall. I think at least there should be a 10%, 10 basis point yield increase in the numbers next quarter if this continues. And because the crude went up to 94, and the ATF prices went, the company has introduced this. And after that, the numbers in fact have come down. Now the crude is approximately at 83, 84. But Indigo has that pricing power. It is almost in a monopolistic situation today. So they may not decrease this surcharge which they have started charging. And hence the stock looks really good because the crude went up. It corrected almost from 2,800, 2,900 to 2,400 levels. Now today it is back about 2,500. I feel stock could trade at 3,000. And again, the festival season is starting, plus the World Cup. Company is actually going to benefit out of it. So 3,000 could be ideal target.
All right, so that is Indigo, but then something from the banking space, Vivek?
I have one more, and I can say this. I feel this is the safest bet an investor can look at today, and it is HDFC Bank. Now, recent numbers, what we saw is after the merger happened, HDFC and HDFC Bank merger, the merged loan book on year has grown approximately 13%, which is actually good. And deposit rates again have actually been impressive, 18% year on year. So when this merger was announced, in fact, even I was talking to many anchors and TV channels that time. I was saying that this problem is going to be next 1 year possibly, because after the merger, there could be some disruptions in the numbers. Now, what I feel is maybe next 2 quarters to 3 quarters at the max. Okay, so these numbers are going to stabilize, and I feel HDFC should again, in fact, most of the brokerages have already started covering it and giving a target of about 2,000. I feel 1,900 to 2,000 could be a good target. And as I said, it looks the safest bet in markets today. So it was a leader. It is going to continue to be a leader. This is a disruption which happened for a short period. I think nothing to fear out of it, and you should definitely invest in this stock.
All right, so Vivek, Indigo and HDFC Bank, medium to longer term view in both of these stocks. But then also one last question, and then we'll wrap up this discussion. We've got the entry points, but then usually what should be your exit point in a particular company or from a particular stock?
Okay. In fact, this is my original quote, and it's there on the Twitter too. That keep in mind while investing, there is nothing called short term, medium term, or long term. It is only profit term. As long as you're making money, in the sense, as long as your company is making money. In the beginning, when we saw those 4 or 5 pointers, how should you choose a stock? One of the things I was told was look at the profit of the company. Is it growing between 12 and 15%? If the company continues making that profit over a long period, the stock will automatically double every 5 years. So 15%, there's a rule of 72, thumb rule of 72, wherein if a company grows at 15%, I think the stock also should double in every 5 years. So as long as the company is continuing making quarter on quarter, there might be small disruptions, but year on year, at least 12 to 15%. I don't think there is any reason for you to sell the stock as long as you actually need the money urgently. So that is one point. And secondly, while entering, if you have a target, okay, if I am getting 10% or 20%, I would be happy, then you should not mind. What happens is people get greedy while entering. uh, they might think, okay, I'll be happy with 20% returns. And when they get 20% in short term or maybe even in medium term, people get greedy that, okay, if the stock is going up, let me hold it on more. You can hold it, but with a trailing stop loss. Otherwise, you shouldn't be greedy in the markets. Market is the only place wherein you keep getting opportunities. We keep telling in life that when the opportunity comes, strike it, don't leave it, or you should immediately grab it. But stock market is one place wherein if you lose 1,000 opportunities, you will get another opportunity again. So you should never be greedy in the markets.
All right, Vivek, thank you so much for being on the show today and helping our viewers with navigating their investment strategies across the right kind of companies. Thank you so much. On that note,